Good afternoon, good evening, good morning, and good day, wherever you may be watching this. I know we have people around the world who participate, so I hope it's a good day for you. This is Arlan Suderman, Chief Commodities Economist at StoneX, back with you to discuss another report from USDA. Not too many surprises on this report, really only one, but we're going to take the time to break down some of the nuances of the numbers and what they mean, as well as look at some of the other outside factors impacting the markets. And so we've got plenty to talk about. So let's go ahead and get started. I want to make sure and show my compliance slide and have it up there long enough for you to take a look at it. Overall, I think the primary numbers here that we're going to be focused on are going to be the corn stocks number and the implications for that. But there's some other numbers in here too that I think do have some interesting implications. I've been talking too much already today. Price is a function of supply and demand is modified by the flow of money. So let's start with taking a look at money flow. We did get the first rate cut from the Fed in this current cycle on September 18th, as you see here on this graphic. We had plateaued and basically paused the monetary policy as far as rate changes back in July of 2023, and then the Federal Reserve made a 50 basis point rate cut on the 18th. That caught some people by surprise. My personal opinion is that it was too much of a rate cut, that they're being too aggressive, but they didn't ask me, so we'll continue to watch this. I do anticipate that we're going to see a continued downturn near term on headline inflation until we see energy prices turn back higher. We've seen a little bit of a rebound. So as we get the October inflation data, we may see even the September data that we get, we may start seeing a stabilization of it. A lot of the decrease in inflation numbers, the headline numbers, have been because of a commodity deflation mode by the funds, which we've talked about before. I anticipated that would go a little bit longer, but we actually saw from the day that, and I'm going to show you this in a little bit, but we saw the mood of the funds change when the Fed made this 50 basis point rate cut. So it did have an impact, and I'm going to demonstrate that here in a little bit with the graphics. But as we look at the longer term 2-year and 10-year yield curve, for the last 2 years, this has been a poor indicator of recession. Remember when it started getting close to inverting, all the pundits are saying it's a big predictor of recession, and that recession never came. And now that we've gone back the other way with the 10-year trading at a premium to the 2-year, all the pundits are saying that's an indication of recession and that it's imminent. But I just think they're going by the old behaviors of the market and economy when it wasn't as full of fiscal stimulus as it currently is. And I think they're discounting that. As we see the consumer price index here, you see that the headline number continues to turn lower, move lower, and getting closer to that mandate at 2.5%, the mandate at 2%. But look at that headline number. The headline number actually inching slightly, not headline, the core number actually inching slightly higher. The core, of course, doesn't have food and energy in it. The service sectors where we're seeing most of that, shelter costs rebounding already with the lower interest rates that the market already had priced into it, as well as transportation costs. And that's largely due to a big increase in car insurance, because car thefts have dramatically increased over the last couple of years, as a lot of states going with cashless bail programs or otherwise not really punishing people who steal cars. And so we've seen a huge increase in car thefts, and particularly in some states, that the insurance companies have to account for with their premiums. Fed really has no control over that. If we look at US GDP, 3% in the last quarter, that's the second quarter of the year. We are today completing the third quarter. So later in October, we'll get our first reading on third quarter GDP. But right now, the modeling is suggesting 2.5% to 3% GDP in the third quarter as well. So not a significant threat there to recession. When you look at the unemployment rate, it did tick lower. Now on Friday, we're going to see this updated. It went from 4.3% to 4.2% last month. If it would happen to read 4.4% then or higher, then we could very easily see a 50 basis point or more rate cut in November, depending on what the November jobs report does, which should come out before the next Fed meeting. But if it's at this level or lower, probably a 25 basis point rate cut based on what the Fed has told us at this point. Now, I'm not going to spend a lot of time on our national debt. I have covered it before, but I do want to keep you engaged in this discussion and keep you updated. If we look at our national debt right now, $35.4 trillion in the upper left-hand corner, and then just to the right of that, you see what our annual tax revenues are of $4.9 trillion. Now below that, I've got a big circle over 4 different spending categories. Medicare, Medicaid is $1.8 trillion. Social Security is just below $1.5 trillion. What we spend for national defense and war efforts is around $930 billion per year. And then what we spend on servicing our debt, $956 billion per year. And this number has just exploded over the past year and a half and higher. Now it's more than what we spend on defense and war. If you add those 4 categories together, that comes to more than it comes to more than $5.1 trillion, just those 4 categories. Well, as I said, right above that, we're looking at tax revenues coming in at $4.9 trillion. So we already have a deficit with just those 4 spending categories. And we haven't got to the other discretionary spending, or we haven't got to food stamps, ag programs, Homeland Security, food stamps, all of our programs to help the poor, education, police, fire, what the federal government contributes for that. I could go on in the things that aren't even listed yet, and we're borrowing money for all of that now. And that's the state of our national budget. And so when interest rates were near zero, it really wasn't much of a problem. But interest rates are above zero now. And we're rolling putting on over the next 12 months expectations about $9 trillion worth of debt certificates. And as interest rates near term are coming down, or the retail customer, we expect to move more toward the stock market with their money. And we already know that foreign investors are moving away, moving money back home. In a lot of cases, it's because they have better opportunities at home. So in other words, our debt market has to have higher yields in order to attract more buyers. I mean, it's just what happened. You increase the supply of debt certificates, you have a decreased demand for it. That decreases the value of the debt certificates, and contrarily, then the yields go up, particularly the medium and longer term. And so what that ends up doing is we continue to expand our debt, is it starts to squeeze out the credit markets, it starts to squeeze GDP and slow economic growth. And that's my concern going forward. This will become an issue again, I anticipate, after the elections, when we have to do something with the debt ceiling before January 1st. So that's going to be a challenge. And eventually what this means, and I notice we have a question on here about this, so I'm going to address it now. We had a question opening up about what this means for agriculture, because we're not addressing this at all to this point. And so what this eventually means is for mid and longer term credit, it means higher interest rates. And that's a higher tax on you. It's a higher tax on all of us as Americans. is those higher interest rates that are necessary, particularly if we see a downgrade in our national credit rating. But even without that, we can see higher interest rates over the longer term because of it. So now let's tie this in all with the commodities. As we look at now